In this presentation, I'll be discussing building useful business models, and in particular, I'm going to be looking at two tools, causal loop diagrams and stock and flow model software. For both causal loop diagrams and stock and flow models, I'm going to be looking at some common themes. These include what are these tools, when are they used, how are they constructed, examples, limitations, and how causal loop diagrams and stock and flow models are related. In this presentation, I'm going to be discussing specifically how these tools fit in the business analyst world. However, they're also applicable if you're a product manager or project manager or anybody who has to take a look at a problem or an opportunity and make some decisions. You'll see in the business analyst world, these tools, causal loop diagrams and stock and flow models, fit into three specific categories: elicitation and collaboration, strategy analysis, and requirements analysis and design definition. So what are causal loop diagrams? Causal loop diagrams are visual representations that map the relationship among items of interest. The items can be practically anything. The items influence other items. They generally support or oppose each other. And the relationships between items can form feedback loops, either reinforcing or balancing. When are causal loop diagrams used? As I mentioned earlier, they're ideal for elicitation, strategy, and solution design. They can be used one-on-one or in group settings. They get mental models out of the heads of participants and onto the table for analysis and discussion. And they help document the ways that items relate or are believed to relate. And they identify areas that need more exploration and evidential support. How are causal loop diagrams created? First, you identify a key issue item and note it on the diagram, such as here, item A. And then you add other items that are contained within the scope and boundaries of the analysis that you're conducting. For example, item B over here. And then you connect the items with arrows showing how each item influences the other. So here's an arrow, A to B. And at the head of the arrow, you put a positive symbol if the relationship is supporting, and a negative symbol if the relationship is opposing. I'll talk about this later. And then you continue to discuss and add items and relationships that are applicable to the issue under consideration. So here's another item here, C. So let's take a look at a simple practical problem and use a causal loop diagram. Here we have a problem of pests that are infesting a farm and crops are suffering. So we have drawn this diagram starting with the pests in this section here. And as the pests increase, the crops that are over here decrease. And so the farmer's solution to this is to add pesticide. And as the pesticide is added, the pests reduce and hopefully the crop output is maintained. We don't see a timeline here. Causal loop diagrams don't capture time, but you could sort of guess at what this might look like forward going. Over here is that diagram. So initially you have pests and the pest population is growing, and as they're growing they are depleting the crops. So the farmer puts down pesticide, which initially stabilizes the pest growth, and then they put down more pesticide, which starts to drop the number of pests, and another application here that drops them further. Now in this case you'll notice the crops don't come back up, but they don't get any worse, and this is in large part because we're looking at the growing season. So during the growing season, because the pest had been influencing the crops initially, the crops aren't going to rebound rapidly as they decrease, but at least you won't lose more crops than you may have. Now in the initial analysis of this pest problem, the farmer could have come to the conclusion that this is great. I'm going to apply pesticide and the pests will go away, my crops will get better. But in this expanded view, there's additional considerations. So we still have the pests, we still have the crops, we still have the pesticide, but now we're also taking a look at bees. Why? We're looking at bees because bees pollinate crops. And so if it turns out that the pesticide is killing not only the pest, but is also killing the bees, then the bees will not be able to pollinate the crops. This effect won't happen immediately. There will be a delay perhaps because again we're looking at a growing season. So even though the bees will be dying as the pesticide is applied during the current growing season, you may not see the effect of that until the next growing season. And again, taking a guess at what this might look like, we can draw the following diagram. So we see again the pests are going up, and then as the pesticide is applied, they're stabilizing, and with further applications, they're dropping. The pests are dropping, the crops are stabilizing, but the bees are being killed off very quickly. Now, over the course of this growing season, that might not make much impact. However, if you take a look at the next growing season, starting without sufficient bees to pollinate, could be in a much worse position even though you're killing the pests off. And that's why these causal loop diagrams are very important, because it gets the bigger picture onto the table. Now, as with any tool, causal loop diagrams do have limitations. They are only as good as the relationships identified, of course. They also don't explicitly show time or the quantity or nonlinearities or inflection points or the effects of delays in feedback. Causal loop diagrams do provide a qualitative map of relationships as a static snapshot rather than a dynamic movie. Let's take a look at stock and flow modeling tools now. What are stock and flow models? They're visual tools similar to causal loop diagrams, but they are dynamic and they offer the ability to capture information over time. So for example, the total amount of pesticide applied over time. They also provide specific relationship details in the form of formula. For example, the number of pests eliminated per pound of pesticide applied. When are stock and flow models used? They're ideal when specific time-related insights are sought. After you have key items and their relationships identified, for example, through the use of a causal loop diagram exercise, and when objective and reliable metrics are available, such as sales history, data tables, and the like. Stock and flow models are created in a fashion similar to causal loop diagrams, but there are significant differences. These are the symbols you'll encounter in a stock and flow model generally. You start by choosing a stock and flow modeling tool. This is a piece of software you'll need. There are several available, some are free, some are fee-based, but you'll have to choose one of these. You start by identifying stocks of interest. Now, a stock is anything that can be added up, such as number of sales orders or pounds of pesticide. You then connect to the stocks flows that increase or decrease the stocks. Those are orders per week, pesticides per quarter, and the like, and that's the second symbol. You can also identify variables and data connections to explicitly show inputs and outputs for stocks and flows in the model. Here's a very simple stock flow model example. It's for a little business that's going to be introducing a new product, and they're contemplating how the pricing will affect the volume relative to their competition. So the assumptions in this model are that unit sales increase as price decreases, and here you see the influence of price on sales. That the cost of goods generally decrease as units increase, and that's this rate in here. I say generally because as the number of units increases, there will come a point perhaps where you have to increase infrastructure that increases cost of goods. There will be a premium price differential because the product that we're going to be putting into the field is going to be better, more feature rich, and so we believe we can have a premium value over the competition. And we are prepared to lower price if competition lowers their price, but we're not going to go past a minimum floor price. So what would this actually look like in a dynamic model? So here we have the model running an Insight Maker, which is a web-based modeling tool. As you can see on the right-hand side here, there are sliders that permit us to adjust inputs, key inputs in the model over here. So running the model now, we can see that as the competition drops their price, we too drop our price down to the floor that we had set, which is $8. And as a consequence of that, our sales are growing up to about 250,000 units over a 2-year period. And looking at the cost of goods and profit, we can see that as the monthly units are going up, the cost of goods are coming down due to economy of scale, and the increase in profits because of that economy of scale. So at this point, let's suppose that management wants to see what happens if we were to drop the floor price. And so instead of starting at the $8, we will now move it down through the use of this slider to a $5 price point. And you can see as a result of that, competition is dropping their price. We're dropping our price down to our floor price of $5 now. The units are increasing up to a point of about 300,000 units over a 2-year period. So by changing the floor price, we do see an increase in units, which is good. But what happens to the profitability and cost of goods? And when we take a look at that, we see some disturbing trends. Here's the increase in units per month because we've dropped our floor price. Here our cost of goods are decreasing, but then they start to rise again, which can happen if there's additional infrastructure, for example, that causes the cost of goods to increase. And then we see a corresponding decrease in profitability down to nearly zero, which is a bad position to be in. So now that we've determined that $5 is too low because of the profitability, we can use the model to dynamically change the floor price and analyze different outcomes. And as a consequence of this, we can reset the floor price to some other figure. It might be $7 or $7.50. A lot of the decision might be based on where we think we can make these cost improvements over time and then make some decisions at that point. Stock and flow models also have limitations, of course, some similar to causal loop diagrams and some unique to the dynamic nature of a stock flow model. They are still only as good as the relationships identified, the reliability of input values, and the formula that create the outputs. However, they can be validated by running the model against historical data over a prior period. And in this way, you can see how well the model creates output that agrees with historical data. But you have to remember that these models may or may not predict future performance. That's really not their intention. That's not the purpose of these models. In fact, a well-known quote by the statistician George Box is that all models are wrong, but some are useful. These are really tools to help improve the thinking and the critical analysis of the problem or the opportunity at hand. So in summary, it's important to choose the right tool. Causal loop diagrams are for qualitative analysis, and stock and flow models are for quantitative analysis. Should be leveraging multiple perspectives from stakeholders so you don't miss any attributes that need to be included in the solution. Should also be seeking reliable objective input and output metrics. This is particularly true of the stock and flow models where you're going to be creating formula. Remember too that things change and you need to be prepared to embrace new challenges to the original assumptions and conditions. And to manage expectations, these tools facilitate elicitation design, but they aren't intended to deliver perfect predictions. These are tools to help the thinking and the analysis and get folks on board as to what is expected based on the inputs, what kind of expected output should you be achieving.